He did everything right. That wasn't an opinion. That was a fact. For years, his financial life followed every rule that was ever suggested, recommended, or quietly enforced. He paid on time, every time. He never missed a due date. He never maxed out his cards. His balances stayed low. His statements were clean. His income was stable. His expenses were predictable. On paper, he was the ideal borrower, the kind banks said they wanted, the kind financial advisors pointed to when explaining responsible behavior, the kind of person the system was built for. At least, that's what he believed. Every month, he opened his banking app with the same calm confidence. The numbers were familiar. The green indicator stayed green. His credit score hovered high enough to feel safe. Not perfect, but solid, respectable, untouchable, he thought. He didn't chase rewards. He didn't play risky games. He didn't open accounts he didn't need. He lived within his means, even when he could have stretched further. He believed discipline was protection. What he didn't know was that discipline was being watched, quietly, silently, and not in the way he imagined. Because the system wasn't looking at his behavior the way he was. It never had. Late one evening, after another long but ordinary day, he sat at his desk and scrolled through his accounts out of habit. Nothing looked wrong. No alerts, no warnings, no red flags. Everything appeared exactly as it always had. That was the most dangerous part. When the change came, it didn't arrive with noise. There was no dramatic notification, no urgent email, no phone call, just a decision. Made somewhere he couldn't see, by rules he was never shown. The first sign was subtle, almost invisible. A credit limit adjustment. Small enough to dismiss, easy to rationalize. Banks do that sometimes, he told himself. Market conditions, policy changes, nothing personal. He moved on. But the system didn't. Behind the scenes, his profile was being reassessed, not because of what he did wrong, but because of patterns he didn't even know existed. Patterns formed not by mistakes, but by consistency, by predictability, by stability. Things humans associate with safety. Things algorithms sometimes associate with risk. His spending habits were analyzed in isolation, not in context. His payment behavior was measured against models he would never have access to. His reliability, once a strength, was now just another data point, one that blended into millions of others. He wasn't unique anymore. He was average. And in certain systems, average is dangerous. Weeks passed, then months. On the surface, life continued normally. Bills were paid, cards worked, scores remained high enough to avoid panic. But something had shifted. Applications that once took seconds now took days. Pre-approvals disappeared. Offers dried up without explanation. Interest rates quietly increased, just enough to notice, not enough to question. Each change alone meant nothing. Together, they formed a pattern no one ever explains. He started asking questions, carefully, casually. Customer service representatives offered rehearsed reassurance. Everything looks fine on our end. Your account is in good standing. These decisions are automated. Automated. That word stayed with him. Automated meant no one was responsible. Automated meant no one could explain. Automated meant no one could fix it. The system was no longer reacting to him. It was predicting him, and it didn't like what it thought it saw. What the models flagged wasn't debt. It wasn't missed payments. It wasn't reckless behavior. It was something far more abstract. Exposure, invisible risk, long-term liability. He had become too reliable to be profitable in the way the system now preferred,
too stable in a model that favored movement, too cautious in an environment that quietly rewarded controlled risk. The system doesn't think like people do. It doesn't care about effort. It doesn't care about intention. It doesn't care that he followed every rule because he believed rules created safety. It only cares about outcomes, and outcomes are measured differently when humans aren't in control. By the time he realized something was wrong, the narrative had already been written. His data profile existed independently of him. It traveled without his permission. It influenced decisions he was never part of. And no matter how carefully he continued to behave, the system was no longer updating its opinion. Because once you're categorized, behavior doesn't always matter anymore. What mattered was how long he had stayed predictable, how little volatility he introduced, how perfectly he fit into a model designed to extract value, not reward discipline. He still believed, at least for a while, that doing the right thing would eventually correct the course, that consistency would restore trust, that patience would be noticed. That belief kept him calm. It also kept him unaware. Because the most dangerous systems don't punish you immediately. They wait. They let you feel safe. They let you believe you're in control. And only then do you discover that control was never yours to begin with.
By the time he understood what was happening, the damage wasn't loud. It was quiet. That's how these systems work. They don't collapse your life in one dramatic moment. They reshape it slowly, invisibly, until the future you planned no longer fits. He didn't receive a rejection letter. He received silence. Requests that once returned instant approvals now lingered in review. Offers he used to ignore stopped arriving altogether. Limits stayed frozen. Conditions tightened without explanation. On the surface, nothing was wrong. Underneath, everything had changed. What the system saw wasn't a man with discipline. It saw a profile, a long-term behavioral record stripped of context, emotion, or intention. Years of data compressed into patterns, ratios, and probabilities. Every decision he thought was personal became just another input. And the system doesn't ask why. It only asks how often. How often did he use credit? How often did he leave balances untouched? How often did he avoid volatility? How often did he behave the same way, month after month, year after year? Consistency in human terms is trust. Consistency in algorithmic terms is predictability, and predictability is something to manage. The system is not designed to reward perfect behavior. It is designed to control exposure, to optimize profit, to reduce uncertainty, to rebalance risk long before humans notice anything is wrong. At some point, he would never know when, his profile crossed a threshold, not a rule, a model boundary. Past that boundary, behavior stopped mattering. He could keep paying early, keep balances low, keep doing everything right. The system had already decided what kind of borrower he was, and more importantly, what kind he would never become. What the system quietly penalized wasn't debt, it was stagnation. Accounts that remain too stable for too long signal limited future leverage. Customers who don't escalate usage don't generate growth. Borrowers who don't respond to incentives don't behave as expected. He didn't revolve balances. He didn't chase promotional debt. He didn't play the game. And systems are built for players. Somewhere in the layers of scoring models and risk engines, his reliability became a ceiling, a cap, a silent limiter. Not dangerous enough to cut off, not profitable enough to expand, so he stayed where he was. Frozen. The cruel part was that no action could reverse it.
Once you are categorized as low volatility, you can't suddenly become high opportunity without triggering a different kind of flag. Sudden changes raise suspicion. Sharp behavior shifts invite scrutiny. The system expects you to remain who it believes you are, and punishes deviation just as much as stagnation. He tried to adjust carefully, slight changes, minor increases, small variations. Nothing moved, because the system isn't responsive in real time. It operates on lag, on history, on long memory. And the longer your past, the heavier it becomes. People think credit scores tell the whole story. They don't. Scores are the surface layer. Beneath them live internal classifications no consumer ever sees. Risk tiers, profitability bands, behavioral archetypes. Those labels don't reset when numbers improve. They don't disappear when mistakes are avoided. They follow quietly, persistently. He wasn't flagged as irresponsible. He was flagged as static. And static profiles are managed, not rewarded. This is the part no one explains. The system doesn't collapse people who fail. It marginalizes people who comply too perfectly. By the time he realized that playing it safe wasn't the same as being safe, years had passed. Years of data reinforcing the same narrative. And narratives, once established, are expensive to rewrite. Not because of rules, but because of inertia. The system assumes the future will look like the past, and if your past is predictable, your future is already priced in. He never missed a payment, but he missed the lesson. Credit systems don't reward morality. They reward behavior that aligns with expected profit cycles. They don't punish discipline. They neutralize it, slowly, silently, without ever telling you why. That's why two people with the same score can live in completely different financial realities. That's why doing everything right doesn't guarantee access. And that's why the most dangerous thing you can believe is that fairness is built into the system. It isn't. Fairness is irrelevant. Only patterns matter. And once your pattern is set, you're no longer making decisions, you're confirming predictions. He still lives responsibly, still pays on time, still believes in order. But now he knows something most people never learn until it's too late. The system was never asking if he was good. It was asking if he was useful. And usefulness is measured in ways no one teaches you. Not in schools, not in banks, not in advice columns, only in data. And data doesn't care how hard you tried. It only remembers what you were.